In trading, you need context. It statistically makes your trades better. Now, I'm not joking when I say that that's what helped an MMT student get 5 million in funding. Of course, it's called money-making concepts for a reason. And in the MMC series, video number 10, we are going to go over usual and unusual context. First of all, we also need to refer back to the order flow lags that we have been going over, because this is what context starts with. It all starts with that narrative. The narrative is formed at those fair value gaps, those fair value areas, and also those swing points, which we've been going over in the narrative videos. Then we need to understand what is context. How are we able to define it? Context, to define it, is the area that we are looking for an entry. And we have two types of context, like we already mentioned. The first one is usual context. Now, the funny thing, and what we're going to explain later on in this video as well, is we are always trading usual context. So when we're looking for a trade ID, we are going to be looking for usual context. But sometimes there will also be unusual context. And this is when usual context fails. Now, how are we going to be trading usual context at all times if we also have unusual context? That's what we're going to go over. But before we understand that, let's dive deeper into usual context. Usual context is again defined as the following. The area where we will take trades. That area where we will start looking for entries is called the context area. And this context area is the following. Let's say we have a fair value gap. That is our narrative. It all starts with our narrative. In usual context is also known as our boundary. What do I mean with boundary? It's a boundary to go into the lower time frame. So as soon as we trade back into that fair value gap, we can go into the lower time frame to look for our entry confirmation. So it's a boundary to perform the next step. Again, that is our narrative. So what we can continue higher from, what we've been going over in the previous videos. Now that alone is not context, because context is from a narrative area to a target. And what is the target? The target is also going to be mechanical, so objective. It is the first opposing PD ray. So let's understand that. What is an opposing PD ray? Well, if we are expecting that bullish fair value gap to continue higher from that, that's a discount array. Since we are expecting higher price from a discount array, the opposing PD ray is going to be a premium array. A premium array right there is that swing high. That is the first opposing PD ray. In other words, that is our target. Now we can still have a different target all the way towards the left. For example, an intermediate high all the way towards the left that we can still trade towards afterwards as well. But this area right here is the context area. This is the area that we are going to be looking for trade IDs. After we take out the opposing PD ray, so the target, we want to have new context, because we're always going to be trading from usual context first before we go into any type of entry confirmation. And again, the reason why this is, and I even made a video about it as well, showing you the data behind context, is because based on data, it makes your trades a lot higher probability. And then the reason why that is because when you have this fair value gap right here, and there's no reason for price to actually continue lower, as in this is the last fair value gap that we can actually continue higher from. And when it's the only area that we can continue higher from, of course, it's a lot higher probability. Now that is something that we will touch on in the last video of the MMC series as well. So as soon as we trade into the fair value gap, that's when we can start looking for our entry confirmation until we reach the opposing PD ray, which through the same time frame will look something like this. Now, this is one form of usual context, and this is one form of the context areas. Because again, we have the first line of defense, we have the overlapping defense, and we also have the last line of defense, and they all create different context areas. So let's dive into the other context areas. And let's first go over the first line of defense and the overlapping defense context areas. First, the first line of defense. We want our first line of defense, ideally, like we mentioned in the fair value gaps video, to be a fair value gap. When that is the case, we have the same exact example right here that we had in the previous slide. From that fair value gap towards the swing high right there creates the context area. Now, in some cases, we will not have that swing point. We will not have that swing high as our opposing PD ray. When that isn't the case and when there's not a swing high and it's only a previous candle high like we're seeing in this example, then from the fair value gap towards the previous candle high, that creates the context area. So it's the exact same, but instead of being a swing high, it's the previous candle high right there. Now for our overlapping defense, we ideally of course want that to be a fair value area. Now right here, when we look at that fair value area and we expect a retracement back into the fair value area to then continue higher. So that's where we can start looking for our entry confirmation as soon as we trade back into the fair value area right there. Then if we have a swing point, the context area is from the fair value area to the swing point. So the first opposing PD ray again right there. Now, let's say we don't have that swing point and we have instead again the previous candle high. Then the context area is again from the fair value area to the previous candle high instead. And that is again where we can then start looking for our entries. Now, both for the FLOD and for the odd, let's go over a few examples. Now, one example that we have right here is on Canadian dollar JPY. We can, like we mentioned, still have a clear target towards the left right there. This intermediate term low, for example. Towards that intermediate term low, we will create unusual context right here. This fair value gap is the boundary. Then on the daily time frame, it also happens to be that we sting into the fair value area right there. Now, what is the target? The first opposing discount array. So that is this swing low right here. So again, we can still have this external target right there. But the area from this fair value gap towards this swing low, that is where we look for our entries. That is our context area. After we have reached that low, we don't look for new entries unless we have new context again. Now, on which time frames to look for context, all things we are going to go over in the last video of the MMC series. Here on the daily, we have context, but even if we go down time frames to the 4 hour, for example, we see that within the bigger context area that we have right here, we also have this context area right there, which again starts with this boundary in the form of that fair value gap. Now, if we take a look at the first opposing PD ray, it is actually this swing low right there. This again, from the fair value gap towards that first swing low, creates the context area. The low below, yes, can still be used as well as this area right here as our overall external targets when we are looking at the 4 hour. If we are looking to trade from 4 hour context and we are looking to confirm this fair value gap on a lower time frame, for example on the 5-minute time frame, then this is the area from that 4 hour value gap towards that 4 hour swing low where we want to look for our entry confirmation. And yes, we can use this bigger daily context low right there as overall another target. But after reaching this swing low on the 4 hour, that's again where we need new context. Now that also depends on what time frames you use. And that is also again something that we will go over in the coming videos. Now taking a look at the 1 hour. Then on the 1 hour, we see inside this bigger 4 hour context area right there. And inside the bigger daily context area that we had, we also have 1 hour context sitting right here. And the cycle repeats where we have the boundary in the form of that 1 hour value gap right there. And this swing low right there is the first opposing PD ray. That again is our target. So let's say we are trying to use a 1 minute entry confirmation. Then from that 1 hour context area, from that fair value gap towards that low, that context area, is where we can look for 1 minute entries. Now on gold right here, we also have a beautiful example of this fair value area right there, which is used as that boundary, that narrative area to then target the first opposing PD ray, which is the swing high right there, creates again the context area from the fair value area high towards the first opposing PD ray towards the target right there. That is something, for example, in that context area, you can look at the 5 minute for an entry until we then reach that target. And afterwards, you will also see that we actually sweep that swing high right there to then return back into a consolidation. Now, the reason why this is also so important to stop looking for entries at this context high, because if we do want to continue lower, context highs and context lows, so the context targets, will actually be used to sweep to then continue lower, which is something that we'll also go over later this video. Now, this is for the first line of defense and the overlapping defense. But let's also take a look now at the last line of defense. What context areas do we have? We have two, and the first one looks something like this, where we have the fair value gap, like we discussed in the narrative video of the liquidity sweep and turtle sweeps as well. We can continue higher from that, but we failed to create a new fair value gap higher. Now this leaves behind a swing low like this. That swing low instead is what we can now continue higher from. So if we sweep that and we continue higher, then this is the context area from the swing low to the swing high. Because the swing low is our boundary to see if we sweep it on the lower time frame, and the swing high is our target. That is the context area that we want to use. Then the other example that we have for the last line of defense is the following, where instead of that swing low sweep, it's that candle signs sweep like we discussed. So it's that previous candle low that we can sweep to then continue higher. We return back into a fair value area, fair value gap. Again, that does not really matter. But the first candle does not reject. The second candle can sweep the previous candle low to then target the first opposing PD ray. That creates the boundary. The boundary is that previous candle low. So if you have the previous candle low marked out, that's where you can start looking for entries to then target the first opposing PD ray, which in this case is that swing high right there. And that will then look something like this. Now let's dive into the chart to give you some examples. On US dollar CHF right here, we have this fair value gap that we might want to continue lower from. Now, when we retrace back into that fair value gap, we see that we have a little bit of a deeper retracement. The first candle is not necessarily a rejection. The second candle sweeps the previous candle high to then continue lower. And this low right here is the target. So again, we are not using the fair value gap at that moment in time as our context boundary. We are using the previous candle high. So it's from the previous candle high towards the swing low right there, the first opposing PD ray. This is our context area. So on the higher time frame, again, that will be seen through a wick right there that we are sweeping it. If we, for example, go into the 15-minute time frame, we have this context area right here. We want to see price trade above the high right here, the previous candle high, with order flow lags to then order flow lags going lower right there. That signals that there's a sweep going on. When we trade back below this high right there, then eventually we can continue lower towards the target sitting right here. Now on US dollar JPY, we have a similar example, but instead of that previous candle high sweep, we have this swing high sweep. So we have this fair value gap right there that we can continue lower from. We do not get the rejection, we do not get a fair value gap lower. Leave behind this swing high right there. This swing high is what we can now sweep to then target the first opposing PD ray in the form of this swing low right there. So again, the fair value gap right there is not the boundary, it's the swing high when the fair value gap fails to push lower. The reason why it's so important to then remove the fair value gap from your chart is because you don't want to use that as a boundary anymore. If you keep on using that fair value gap, then there's no mechanical or objective rule that we can make when to stop looking for entries. So when the fair value gap will most likely not hold. That's why it's so important to mark out the correct unmitigated PD rays. So here is the swing high, not the fair value gap. Then from that swing high, we can again go into the lower time frame to confirm it, that we are sweeping it and that we are targeting this low sitting right there. If we don't use the PD rays that we mentioned in the MMC series, or we don't mark them correctly, as in we are using, for example, mitigated PD rays that have already been traded into before, then we will lose a lot of accuracy. The fair value gaps that we go over have the most accuracy. Now, these are all the usual context areas. But like we mentioned, we also have unusual context. Unusual context starts with the following understanding, like we've already mentioned in previous videos as well. The market is doing one of two things. It is either offering fair value or it is seeking liquidity. And when we are not offering fair value anymore, we will be seeking liquidity. This all starts with a fair value area. So right here, we have the high of the fair value area. And the complete fair value area is from the high towards the low right there, towards the swing low. When we have this fair value area and we retrace back into it right here, we will sometimes see that we will create a rejection, but that rejection will actually fail. So we do not continue higher anymore, because the only area that we have not offered fair value just yet was the area above the swing high right there. Now this means that when we continue lower and create a very deep retracement, that we are not offering fair value anymore. This is seen through a failed rejection from the fair value area, to then a bearish fair value gap created instead. Now that bearish fair value gap is, you probably guessed it already, is of course usual context. This fair value gap right there is what we can use as usual context to having the external target, so the eventual target, the fair value area low right there. But again, from that fair value gap towards the first opposing PD rate, that creates the context area. And that is then what we can eventually continue lower from towards the fair value area low. And this is why we mention when we're talking about the last line of defense and we have a fair value gap in the lag. So we have a usual order flow lag and we have a fair value area. Then the last line of defense is not necessarily something we want to trade from. It's something we want to trade towards when the fair value area fails to offer fair value and then continue higher, because then we will be seeking liquidity. And this is also why we are always trading usual context. The bigger picture could be called unusual context, but we're always trading usual context, even inside of unusual context. Now, one example of this unusual context is actually something that we have already gone over right here on Canadian dollar JPY. We have this fair value area sitting right here from the swing high towards the swing low, intermediate high towards the intermediate low in this case. We see that we retrace back into it right here, get a rejection from it, then fails to follow through higher, so does not create a new fair value gap higher. Afterwards, we create a new fair value gap going lower instead. And this is what we then looked at in the previous example of the first line of defense. That is the usual context that we can trade and use to then eventually target the fair value area low right here. Again, since we are not offering fair value anymore, we can assume that we are targeting liquidity, and that liquidity is the fair value area low. Another example is on GBP Australian dollar right here. We have this fair value area towards the left. Now that fair value area in itself is of course a context area towards this high right there. Now remember when I told you that once we reach a context target, context high, context low, that oftentimes is also used to sweep to then continue lower or continue higher. That's why it's so important to stop looking for entries right there and wait for new context. Then here we continue higher and we reach that high. If we go down a time frame, on the 4 hour right here, we see that we have signs of a sweep of this high right here, where we do not necessarily get a rejection of the fair value area initially. And the reason for that is because the fair value area right there is not exactly overlapping with a fair value gap. So instead, we are already sweeping the high right there. When this is the case, then we will have the same follow-up with fair value gaps sitting right here, which we can continue lower from, which creates the usual context towards the fair value area low right here. So the difference between this example and the previous example that we had was that the previous example had the fair value area perfectly overlapping with a fair value gap. And here, that's not the case. Here we already sweep the high of the future that was a fair value area. Then here we create a bearish fair value gap to then continue lower from, towards the fair value area low, because now we are seeking liquidity. Remember in previous videos when we talked about gold, where we talked about the sweep of this high. When we have this fair value gap is a low probability to trade from right there to continue higher. Why? Because here, since we are sweeping this high, the fair value area is now the first line of defense like we mentioned. We are not offering fair value anymore. So the fair value area low in the form of the low all the way right here could become the target. In the meantime, of course, we in this lag higher, we have closer targets as well. For example, this fair value gap sitting right there. Then we create a usual context right here, again, towards the targets that we have right here as well. Now, the last example, which is a beautiful example, I want to go over because we heavily capitalized on this situation right here on crude oil on the daily time frame as well. We have this fair value area sitting right here, where we have the fair value area high, which again is also that last line of defense, right? In that order flow lag going lower. And we also have this swing low, which is the actual fair value area low right there, which we can continue lower from. Then here we see we trade back into the fair value area low. We do not necessarily get a clear sweep, so we do not have those wicks. But we do create an expansion phase candle coming back into that fair value area, so a lot of momentum. We create a rejection, the rejection fails. We create a new bullish fair value gap right there. then eventually the target is very clear. The last line of defense, in other words, the fair value area high right there, because now we are seeking liquidity. We're not offering that fair value anymore, so we are instead seeking liquidity. Where the last line of defense is again not something we want to trade from when we have this order flow lag, it's something we want to trade towards. Now we do not have this usual context on the daily, but if you go down time frames, you will find beautiful usual context to then target the fair value area high right there. And again, the reason why this all happens is because the market is either offering fair value or seeking liquidity. So in this example, we have the following. We have the movement low right here, which offers sell side. Afterwards, we have the movement high right there, which offers buy side. So the market is giving a fair chance for both sellers and buyers to get involved. And after it continues lower, below this low right here, it has now offered fair value in this previous area, which is from the low towards that high right there, because this is where it's offered fair value, where both buy side and sell side has been offered. Both buyers and sellers got a fair chance to get involved. The only area where we have not offered fair value just yet is below the low that we just took, because here we only see sell side right there. So if we want to offer fair value, we can retrace back into the fair value area low to then continue lower. Because if the market is going to offer fair value and continue lower, then that's the only fair value that we still need to offer right there. If this is not the case and we have offered the fair value, but instead we fail to continue lower and we create fair value gaps going higher, then we can assume if the market is not offering fair value, it is seeking liquidity in the form of the fair value area high, which is this fair value area right there. And this is what's called unusual context, and we trade usual context towards it. Now, why is this unusual context? Because when we offer this fair value and continue lower, it starts off with usual context. But something unusual happens because we do not continue lower. We have offered the fair value and instead we start seeking liquidity. Again, you will never understand any of the concepts, the money-making concepts, if you do not start doing case studies. The case study for this video is the following. Study context areas and see where potential entries form. So already feel free to go into the lower time frame and see if you can start looking for those entries as well. Not real entries, just simply in hindsight backtesting as well. Feel free to use the study notion, the first link in description. Again, completely free. It will help you a lot as well. All right, perfect. Thank you.